Hey everyone, it's Julie here with TipRanks, and today we're taking a look at 3 strong buy energy stocks that have been dipping in price. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. If you can believe it, we are just 1 week away from Christmas, so I hope everybody is getting ready for the holidays. Today, we're going to take a look at 3 energy stocks that have been trading in the red over the last few months, but still come in with a strong buy consensus from Wall Street analysts. We're going to take a look at these companies, what it is that they do, and what those analysts are predicting for the stock's future. We found these companies over on the TipRanks Top Analyst Stocks page. This is found right under the Ideas menu, and you'll find a collection of companies that have been picking up buy ratings from 5-star analysts recently. So today I wanted a large or mega market cap narrowed down to a couple different sectors here, and then I sorted by recent stock behavior to see which companies have been trading in the red. You can check out the Top Analyst stock page for yourself over on the TipRanks website or by downloading the TipRanks mobile app. Links are in the description down below. Just before we get into today's stocks, this is a reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's dive right into our 3 strong buy energy stocks. First up is a company that could fall into both the energy and technology sector with First Solar. Trading under the ticker FSLR, they're currently priced at $193 per share. Now overall, they are in the green in the past year, up over 12%, but in the last 6 months have dropped 25% and are down about 19% over the last 3 months. First Solar is a leading American solar technology company. They're focused on the design, manufacturing, and sale of photovoltaic solar modules using their proprietary thin-film semiconductor technology. They're also known for their cadmium telluride, or CDTE, solar panels, which are different from the more common silicon-based ones. They have advantages like lower manufacturing costs, higher energy yield in hot climates, and a smaller carbon footprint. They also have their system segment, which offers development, construction, operation, and maintenance of these solar power systems. They shared their third quarter earnings report at the end of October. Earnings and revenue did fall short of expectations, and they did have to trim their guidance on some India headwinds. They reported third quarter earnings per share of $2.91, which did fall 24 cents short of analysts' expectations, and revenue came in at $887.7 million, missing by about $192 million. Looking at some of the lowlights from the earnings call, they did mention those challenges in the Indian market, with Chinese dumping leading to depressed ASPs affecting domestic sales and some operational challenges and delays. But looking at the highlights, they did have record production and inaugurated their new $1.1 billion facility in Alabama and noted a strong contracted backlog. Many analysts slightly lowered their price targets on the stock following that earnings report while maintaining their buy ratings. But just a couple of weeks ago, we did have an analyst from Piper Sandler who increased theirs. And that was because the Friday prior, the DOC released a long-awaited preliminary determination, or PD, surrounding anti-dumping duties from certain countries. The rates were above expectations, and based on the PD, panel pricing could rise materially, imports likely decline, and a deafening narrative surrounding UTE-scale project delays could emerge. First Solar is the sole PD beneficiary in the firm's coverage. With 23 current analyst ratings, First Solar does come in as a strong buy with 20 buy ratings and 3 holds. And the average price target of $277 would imply an upside potential of 44% from current prices. Looking at those recent ratings down below, all of our price targets have a double-digit upside potential. Our low end is a hold rating at $218 with an upside of over 12%, while our recent high-end price target is $335 for an upside of over 73%. Number 2 on our list today is Cenovus Energy. They trade under the ticker CVE, currently priced just shy of $15 per share. While they were climbing into the spring there, they then took a decline, and in the past year are down over 8%, falling about 20% in the last 6 months. Cenovus Energy is a Canadian energy company primarily focused on the exploration, development, and production of natural gas, oil, and natural gas liquids. They operate across the energy value chain, from exploration and production to refining and marketing, with a strong emphasis on both conventional and oil sand resources, aiming for operational efficiency, environmental responsibility, and community engagement. Operations in the oil sands of northern Alberta, as well as conventional oil and gas production across western Canada, as well as some offshore assets. They shared their third quarter earnings report on October 31st, where they did have mixed results, falling short on earnings but beating on revenue. They reported Q3 earnings per share of 29 cents, falling just 2 cents short of analyst expectations, while revenue came in at $14.2 billion Canadian, which came in ahead of estimates. The company said that they efficiently and effectively are progressing their major projects and that their growth plan is on track to deliver increased production that will enhance shareholder returns for the long term. And just about 5 days ago, we did have a 5-star analyst at Jefferies assign a buy rating to the Cenovus stock. They said that their production guidance for 2025 aligns with market expectations, and a major point of interest for investors is the U.S. downstream operations, where turnaround expenses are higher than anticipated due to procurement activities planned for the second half of the year. They are in their final year of their 3-year growth plan, which includes significant projects such as the Narrows Lake startup in mid-2025, the completion of an offshore facility by 2026, and preparation for their Foster Creek optimization projects. These initiatives suggest a strong growth trajectory for the company. With 10 current analyst ratings, Cenovus Energy does come in as a unanimous strong buy. And the average price target is $21.31, implying an upside potential of 43% from current prices. Looking at those ratings down below, once again, all of our price targets do have a double-digit upside potential. Our recent low-end price target is this $17 here from BMO, with an upside of 17.5%, while our high-end price target would be this from JP Morgan at nearly $24, an upside of about 60%. If you've made it to our third stock today, then this is a reminder to make sure you hit that thumbs up button. Last but not least, we're taking a look at Diamondback Energy. They trade under the ticker FANG, currently priced at $159 per share. This is another one that is in the green overall over the past year. Year to date, the stock is up 7%, but in more recent months has been declining, dropping 16% over the last 6 months and about 12% over the last 3. Diamondback Energy is an independent oil and gas company with operations focused in the Permian Basin. Their main activity is drilling for and producing oil, natural gas, and natural gas liquids, targeting multiple geological formations within the Permian Basin, including Wolfcamp, Strawberry, Clear Fork, Bone Spring, and Klein. These operations involve both horizontal and vertical drilling techniques, with a strong emphasis on horizontal drilling to access shale oil and gas. And they shared their third quarter earnings report on November 4th, also coming out with mixed results with a miss on earnings but revenue beat. Their third quarter earnings per share came in at $3.38, missing expectations by 64 cents per share, while revenue of $2.65 billion did grow 13% year over year and beat by $240 million. Looking at the earnings call summary, there were some macroeconomic concerns, particularly regarding an oversupply in 2025, but several highlights as well, including a reduction in their corporate break-even rate, operational efficiency gains, and a focus on their free cash flow. Over the last couple of weeks, several analysts have slightly lowered their price targets while reiterating buy ratings, including one at UBS. Then we also had an analyst at Goldman Sachs who resumed coverage on the stock. The UBS analyst sees a mixed outlook for energy in 2025, noting on the positive side that it seems natural gas momentum is building, but adding that crude oil prices face downward pressure and attractive valuations may not be enough to bring in new investors. Meanwhile, the analyst at Goldman Sachs says that Diamondback continues to offer a prudent capital allocation strategy focused on per-share growth in shareholder returns, which will continue to create shareholder value. They said that the recently closed merger with Endeavor Energy presents significant improvement in inventory with room for incremental improvements in capital efficiency at scale. Diamondback Energy also has 23 current analyst ratings, coming in as a strong buy with 20 buys and 3 holds. And the average price target comes in just shy of $215, implying an upside potential of 35% from current prices. Looking at some of those recent ratings down below, you'll see a mix of analysts slightly lowering or slightly increasing their price targets. On the low end, we have a couple around 191 or 192 for an upside of about 20%, while our high-end price target is 255 from TD Cowen for an upside of 60%. So that is a quick look at 3 strong buy energy stocks that have been dipping in price lately, so they could be worth putting on your watch list and keeping an eye for a turnaround soon. Let me know which of these catches your eye the most. I always love hearing from you guys. And of course, please keep in mind that these videos are never a suggestion to buy or sell any specific stock, just sharing what those Wall Street analysts are looking at, so please make sure you always do your own research and due diligence. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.